All right, so now we are starting with different types of ratios. Primarily, there are 5 types of ratios, which are liquidity ratios, leverage and solvency ratios, activity or efficiency ratios, profitability ratios, and valuation ratios. So, different types of ratios focus on different things. Like liquidity ratio focuses on uh, what is the company's ability to pay down its current liabilities. Leverage or solvency ratios tell us about company's ability to uh, fulfill its long-term obligations. Activity efficiency ratios tell us how efficient, how well the company is able to manage its working capital, manage its cash. Profitability ratios tell us about the ability of the company to generate profits from revenues, and valuation ratios tell us about uh, what are the different multiples the company is trading at uh, in the market, right? So we will start with liquidity ratios. Our topic is liquidity ratios, and brief intro about the topic. These ratios tell us about uh, what is the liquidity position of the company, right? That means if we look at liquid assets, uh, we can say that we are talking about current assets and current liabilities here, right? So what is the ability of the company to fulfill its short term obligations or current liabilities? That is captured through liquidity ratios. Liquidity ratios are financial indicators used to assess a firm's ability to meet immediate financial obligations and effectively manage day-to-day fiscal operations. So, what are my immediate financial obligations, right? For example, uh, short-term debt which we need to pay down this year, or there are some salary payables, or we need to pay some creditors, uh, rent payable. All these are current liabilities. So, does the company has the ability to pay its current liabilities effectively? That we capture through liquidity ratios. Liquidity ratios provide valuable insights into a company's capacity to fulfill short term obligations, which is pivotal for financial well being. Operational efficiency, they mirror how proficiently a company handles its working capital and cash flow. Liquidity ratios include current ratio and quick ratio. So primarily within liquidity ratios, we have current ratio and quick ratio. What is current ratio? Current ratio stands as a significant liquidity metric used to gauge a firm's immediate financial well-being and its capacity to fulfill short-term financial responsibilities. It is calculated as current assets upon current liabilities. So, current ratio is equal to current assets upon current liabilities. So, it is telling us how much current assets do we have to cover our current liabilities. If it is one or more, it means if it is more than one, it means that our current assets are more than current liabilities, and we can easily fulfill our current liabilities through our current assets. Whereas if it is less than one, it means our current assets may not be sufficient to cover our current liabilities, and we need to generate funds from somewhere else to cover our current liabilities. Current assets encompass cash, cash equivalents, accounts receivables, inventory, debtors, prepaid expenses. Current liabilities include short term debts, accounts payable, and other obligations due within 1 year. So, how do we interpret it? As we discussed, a current ratio exceeding 1 indicates that the firm possesses more current assets than current liabilities, signaling its capability to cover immediate obligations through its current assets. A current ratio substantially above 1, for example, 2 or higher, may signify excess liquidity, but could also point to underutilized assets, right? So, although we want this to be higher so that we can be very sure that current liabilities can easily be covered by current assets, but if it is too high, If it is 2, 3, 4, that means lot of our capital is stuck in current assets. Maybe we don't need so much of current assets as we have currently, right? So what we need to do here is we need to compare the current ratio of our company versus other similar companies within that industry, right? So for different industries, this ratio could be different, and it's perfectly fine. For example, if you look at IT company, or if you look at service based company, uh, you might find that the current ratio is higher. But if you look at, let's say, some other set of companies or some other industry, uh, which are lower on current assets, which have a lot of payables, uh, for example, metal mining or airline industries, the current ratio could be lower. And that is how the industry operates. That is how that set of companies operate. So that's fine. Uh, so when we are looking at a particular ratio, we need to look at it in comparison of other similar companies, and then we can comment on it whether this company is doing well or not, right? So that means I cannot compare the current ratio of TCS versus the current ratio of Indigo. That would be a wrong comparison. They are into different industries. So within that industry, what is the current ratio? What is the relevant current ratio? And then we can do that comparison of companies within that industry. That is more logical, and that is how we should go about ratio analysis in general. It is crucial to recognize that industry benchmarks differ, necessitating a comparison of the current ratio against sector specific standards. So, as I mentioned, for different industries, the benchmarks could be different, the standards could be different. So, that's why we need to look at the current ratio of companies within the same sector or the same industry, and then do a fair comparison of which company is doing better in terms of current ratio or not. Next liquidity ratio is quick ratio. The quick ratio, also recognized as the acid test ratio, stands as a pivotal liquidity measure that assesses a company's capability to satisfy short-term financial commitments without depending on inventory sales, right? So this is the quick ratio is like a stress test of current ratio. Yeah. So in current ratio, in the numerator, we were using current assets as the numerator. But here in the quick ratio, we are deducting inventory and prepaid expenses from the current assets. So what we are saying here is, if inventory does not get converted into cash quickly, yeah, um, and obviously prepaid expenses are the expenses which we have already prepaid, so there is no cash coming in from there. And if inventories also don't quickly convert into cash, so we are removing these two items from current assets, and then whatever are the remaining current assets, uh, those remaining current assets, do they have the ability to pay down the current liabilities or not, right? So we have removed a couple of items from current assets. So quick ratio would be lower than your current ratio, right? So that's why we can also say that is the stress test of the liquidity of the company. That means even if we don't have these two items, does the company still has the ability to satisfy its current liabilities uh, through those remaining current assets? Interpretation: a quick ratio exceeding 1 signals that the company can address immediate obligations without relying on inventory turnover, indicating a cautious approach to liquidity. A quick ratio significantly under 1 may warrant attention, implying possible challenges in meeting short term obligations without leaning on inventory liquidation. So that means if the quick ratio is less than 1 or significantly less than 1, that means the company may has to rely on liquidation of inventory. They have to convert the inventory into cash so that they are able to meet current liabilities, right? So again, closer to 1 or slightly higher than 1 is uh, what would make the company comfortable in terms of meeting its current liabilities. But again, as I said in the previous ratio, that is current ratio, that we need to look at ratios from the industry standard. What is the industry benchmark, right? So for a paints industry, this benchmark of liquidity ratios can be different from automobile industry to a telecom industry to a FMCG industry. These standards, these benchmark, what is the um, correct value for these ratios may vary from industry to industry. So fair comparison would be comparing one company with another company in the same sector and then figuring out who has better liquidity position. Let's look at how do we calculate it. So we have data of a company for 5 years. Uh, Here we have the balance sheet data first. This we are doing to showcase how do we calculate ratios. So briefly, I'll summarize what do we have here. First, we have the balance sheet data, current assets, non-current assets, current liabilities, non-current liabilities, and total shareholders equity. So this is our balance sheet data. And then we have income statement data in which we have revenue, expenses, and profits. So what we are going to do here is we are going to uh, look at how do we calculate ratios. Okay, just a second. So here we have current ratio. How do we calculate it? Current assets upon current liabilities. So we will look at total current assets, which is this much, divided by total current liabilities, which is this much. So it's coming out to be 7.8, which is very high. Similarly, we can do this calculation for all the remaining years as well. And our analysis of current ratio data could be that company has significant ability to pay down its current liabilities using current assets. In fact, we can say that it is much more than what the company may ideally need, right? So if it is closer to 1 or slightly higher than 1, uh, that would be enough. But here we are talking about 7.8, 4.4, 2.9, 2.7, and 3, which is very high. So roughly we have uh, 4 times the current assets. On average, we have close to 4 times the current assets as compared to our current liabilities. So maybe the company is holding up too much of current assets. uh, too many Too much capital is stuck in the current assets, maybe in the form of inventories or accounts receivable or other current assets than required. But again, uh, we can do that comment, we can make that comment only after comparison of this company versus other companies in the similar sector, right? Let's look at quick ratio. This is current assets minus inventories. This is total current assets minus inventories minus prepaid expenses divided by current liabilities. So our current quick ratio is coming out to be 3.63. So as we discussed, this would be lower than our current ratio. This is the stress test of liquidity. That means even if the company is not able to convert its inventory into cash, that means the company is not able to sell its inventory and generate cash from inventory, uh, even then the company has enough capacity to pay down its current liabilities. Okay.